long-term capital management. How the smartest people in the world lost everything. 1. Greenwich, Connecticut. White-collar men writing mathematical equations in glass buildings. These aren't ordinary people. 2 Nobel Prize-winning economists, a former Federal Reserve vice chairman, Wall Street's most feared bond trader. They didn't just want to beat the market. They wanted to make the market irrelevant. His name was John Merriweather. And for a while, it seemed like he had cracked the code of money itself. Merriweather didn't come from old money. He grew up in a working-class neighborhood in Chicago, earned his MBA from the University of Chicago, then walked straight into Salomon Brothers, one of the most ruthless trading floors on the planet. He didn't just survive there, he dominated it. By the late 1980s, his desk alone was generating 80 to 100% of Salomon's entire global earnings. One desk, one man. The whole machine ran on him. But in 1991, a scandal broke. One of his subordinates had been manipulating US Treasury auctions. Merriweather didn't do it, but he knew. He paid a $50,000 fine and walked out the door. For most people, that would have been the end. For Merriweather, it was just the beginning. He came back with something bigger. In 1993, he started making calls, not to just anyone. Robert Merton, Harvard professor, architect of modern financial theory. Myron Scholes, co-creator of the formula that changed how the entire world priced risk. David Mullins, a man who had literally sat inside the Federal Reserve and helped shape US monetary policy. These weren't hired hands, they were partners, and together they built long-term capital management. By February 1994, the day LTCM began trading, they had raised just over $1 billion, 80 investors, each paying $10 million minimum just to get a seat at the table. Bear Stearns, Merrill Lynch, the Italian Central Bank, university endowments, everyone wanted in. The strategy was elegant, almost too elegant. Find bonds that should trade at similar prices. When the gap between them widened irrationally, bet that it would close. Small differences, massive leverage, guaranteed convergence. That was the theory. That was always the theory. The early results were obscene. 21% in 1994, 43% in 1995, 41% in 1996, 17% in 1997. Every year, every trade. The models worked. The academics became legends. The traders became gods. And somewhere in there, a dangerous thought took root. What if they were actually right? By early 1998, the portfolio exceeded $100 billion. Their swaps exposure sat at $1.25 trillion, equal to 5% of the entire global market. One hedge fund, 5% of everything, and almost none of it was their own money. For every dollar they owned, they had borrowed 30 more. The models said this was fine. The models said the risk was diversified and manageable. The models had never been wrong before. Warren Buffett had been watching. He said those 16 people probably had the highest average IQ of any group working together in any business in the country. And then he said something else. All that intelligence, all that experience, all that brilliance was pointed in exactly the wrong direction. Nobody listened. Then the world broke. In July 1997, the Thai baht collapsed. The Asian financial crisis spread like fire across emerging markets. LTCM's models absorbed the shock. They had hedged every position. They were fine, or so they thought. On August 17, 1998, Russia devalued the ruble. Then it defaulted on its debt. Investors around the world panicked, all of them. At the same time, they dumped anything risky and ran towards safety. The spreads LTCM had bet would converge exploded apart instead. The models had no answer for this. There was no answer. In August alone, LTCM lost 44% of its capital, $2.1 billion, in a single month. The fund that had seemed mathematically immune to failure was bleeding out in real time. By September 1st, equity had dropped to $2.3 billion. Merriweather sent a letter to investors. He called the losses extraordinary. He offered them the chance to put in more money on special terms. Then came the line that revealed everything. Existing investors could not withdraw more than 12% of their money until December. The doors had closed. By September 22nd, equity had dropped to $600 million. The leverage had only grown. Banks started doing the math and didn't like what they found. If LTCM collapsed, the forced liquidation of its positions would send shockwaves through every major financial market on Earth. This wasn't just one fund failing. This was a potential unraveling of everything. The Federal Reserve Bank of New York made the call. They put the biggest banks in the world in a room and told them the situation. On September 23, 1998, 14 institutions injected $3.6 billion into LTCM. Goldman Sachs, Merrill Lynch, JP Morgan, Barclays, Deutsche Bank, each one writing a check not because they wanted to, but because the alternative was worse. That same morning, Warren Buffett made his own offer. Buy the partners out for $250 million. Inject $3.75 billion in fresh capital. At the start of that year, the firm had been worth $4.7 billion. Buffett gave Merriweather less than 1 hour to decide. The time ran out. The smartest people in the world had run out of time. The fund was quietly wound down over the following year. The partners lost nearly everything. The Nobel laureates went back to academia. Merriweather eventually started another fund. It also failed, but here is the part that should keep you up at night. Every lesson from LTCM was studied and documented. Regulators wrote reports. Business schools built entire courses around what went wrong. And then, 10 years later, the same leverage, the same blind faith in models that couldn't account for human fear, helped bring down the entire US financial system in 2008. We didn't learn. We never learn. Because the seduction is always the same. Someone brilliant builds a model. The model works. The money pours in. And somewhere in the third or fourth year of being right about everything, the possibility of being wrong stops feeling real. That is how genius fails, not with a moment of stupidity, but with one final, fatal act of certainty. LTCM, 1994 to 1998. From 1 billion to 1 trillion in exposure, then to nothing in 4 months.